Have you ever faced a really big decision at work, maybe launching something new or dealing with like volatile currencies, that feeling of uncertainty?
Yeah, that knot in your stomach.
Exactly. And you just wish you could, well, manage the risk better. Now, corporations, they spend huge amounts of resources, time, money, you name it, trying to manage all sorts of risks, financial ups and downs, market shifts, operational hiccups.
They definitely invest heavily in it.
But here's the big puzzle, the one that probably keeps some finance folks up at night. Does all that work, all that expense, actually make the company more valuable?
Or is it maybe just the cost?
Yeah.
Significant cost, potentially without a clear payoff.
Right. It's a really fundamental question. So today we're doing a deep dive into corporate risk management. We want to figure out when and, if managing risk truly adds value.
We've got a great source article here that looks at both the theory and the practical side of things. It pulls out some key ideas.
And our mission is basically to unpack this. Look at different views on risk, find those real-world situations where, okay, here, strategic risk management actually makes a difference. Okay, let's get into it.
So, first off, what do we mean by risk here? In this corporate finance context, we're generally talking about the volatility of returns.
The ups and downs in performance.
Exactly. Positive and negative swings. And it's not just a vague feeling, it's something you can quantify. Using statistics like probabilities, standard deviations, how things correlate.
Okay, so it's measurable. And risk management, then, is about making choices to change how exposed the company is to that volatility.
That's it. Like maybe swapping a floating interest rate for a fixed one. You pay a fee, but you get more certainty about your financing costs.
Makes sense. Trying to smooth things out.
Right. And the ultimate goal, the reason for doing all this, is to increase the company's market value.
How does that happen?
Well, two main ways. You either increase the future cash flows the company is expected to generate, or you reduce the rate of return that investors demand for holding its stock or debt, or ideally both.
So a good strategy adds more value than it costs, like increasing the net present value, the NPV.
Precisely. It needs to boost that NPV at a lower comparative cost than the benefit it brings.
Okay, that seems logical. Manage volatility, increase value. But then we hit this perfect market argument. And this is where it gets, well, really interesting, maybe even counterintuitive.
It definitely throws a spanner in the works, theoretically speaking. So imagine a perfect market, no transaction costs, everyone has the same information, rational investors. Just a theoretical construct, of course.
Right, not the real world.
Not the real world. But in this perfect world, investors who hold well-diversified portfolios owning lots of different stocks are basically only exposed to systematic risk.
That's the market-wide risk, right? The stuff you can't diversify away, like big economic downturns.
Exactly. Because any firm-specific risk, the unique ups and downs of one single company gets washed out in their big diversified portfolio. It cancels out across all their holdings.
Okay, so if I own hundreds of stocks, one company having a bad year doesn't sink my whole portfolio. The big market trends matter more.
That's the idea. And according to things like the capital asset pricing model, or CAPM, the return these diversified investors demand is based only on that systematic risk they can't escape.
So where does that leave corporate risk management?
Well, the research suggests that in this perfect market scenario, companies whose shares are held by these diversified investors don't actually increase value by trying to reduce their own company's specific risk.
Because the investors already did it for themselves.
Exactly. They've already diversified it away personally. So any effort by the company to manage that specific risk is, at best, neutral to benefits, just equal the costs. Or, worse, it could actually destroy value if the costs are higher.
Wow. So theoretically, a lot of corporate risk management could just be wheel spinning or even counterproductive for those big, diversified investors.
In that perfect world, yes. But, as you said,
the real world isn't perfect.
Thank goodness for that, at least for risk managers.
Mm-hmm.
The real world is full of what economists call market imperfections. And these imperfections, that's where the opportunities pop up for risk management to actually reduce costs and potentially add real value.
Okay, let's dig into these imperfections. What's the first one? You mentioned a paradox involving company size.
Yeah, this is a fascinating one. Logically, based on what we just discussed, you'd think smaller companies would benefit most from risk management.
Why is that?
Because their ownership is often concentrated. Maybe the founder still owns a huge chunk, or they have fewer, less diversified shareholders. These owners are exposed to both the company's specific risk and the systematic risk.
So unlike the big diversified funds, these owners haven't diversified away the company's unique risks.
Right. So if the company reduces its specific risk, those owners directly benefit. It lowers their personal risk exposure. So theory suggests smaller companies should be doing a lot of risk management.
But that's not what happens.
Nope. Empirical studies consistently show it's the larger companies, the ones with the already diversified shareholders, that actually do most of the risk management activities, like hedging.
Why? If the benefit is theoretically smaller for them.
It boils down to cost, mostly. Risk management tools and expertise can be really expensive. Think derivatives trading, sophisticated analysis.
Big fixed costs.
Often, yes. Large fixed costs. Smaller companies just might not be able to afford it, or the cost per dollar of risk managed is too high. Larger companies have the scale to make it more economical.
So it's an economies of scale thing. Even if smaller firms could benefit more theoretically, they're priced out practically.
That seems to be the prevailing explanation. It's a practical constraint overcoming a theoretical benefit.
Interesting. Okay, imperfection number 2, taxes. How does risk management interact with the tax man?
Well, think about progressive tax systems. Many countries have them, where the tax rate increases as profits go up.
Right. Earn more, pay a higher percentage.
Exactly. So if your earnings are really volatile, huge profits one year, losses the next year, you might end up paying more tax overall than if your earnings were stable, even if the average profit over time is the same.
Because you hit those higher tax brackets in the good years.
Precisely. Reducing that earnings volatility, smoothing things out, could potentially keep the company in lower average tax brackets more consistently. Less variability might mean less tax paid over the long run.
That sounds like a very tangible benefit. Does it always work like that?
It's not universal, no. Academics point out it's particularly relevant in specific situations. Like, if a company has past losses it can use to offset future profits, tax volatility matters more. Or for multinationals dealing with complex tax treaties between countries that can create effective progressive rates too.
So it depends on the specific tax code and the company's situation.
Very much so. But it's a clear potential channel for risk management to add value by reducing tax outflows.
Okay, let's move to something maybe more dramatic. Insolvency and financial distress.
Right.
What's the difference and how does risk fit in?
Sure. Insolvency is pretty stark. The company literally can't pay its bills when they're due. Financial distress is a bit fuzzier. It's less severe. The company's still operating. But things get difficult because everyone dealing with it, customers, suppliers, employees, starts getting nervous about future insolvency.
Like the ship is taking on water, even if it hasn't sunk yet.
Good analogy. And this distress, even short of actual insolvency, comes with real costs, both direct costs like hiring lawyers and advisors, but also significant indirect costs.
What kind of indirect costs?
This is where it gets really interesting. The main indirect costs often come from higher contracting costs with stakeholders. Well, think about it. If you're a customer, are you going to buy a complex piece of equipment needing long-term support from a company you think might go bust? Probably not. Unless they give you a massive discount or ironclad warranties.
Right. You'd be hesitant.
Or employees, they might demand higher salaries or bonuses to compensate for the job insecurity. Senior managers might want huge signing bonuses, gold and hellos, because they're taking a risk joining a potentially troubled firm.
And suppliers.
Suppliers might tighten credit terms, demand cash up front, refuse long-term contracts. Basically, everyone the company deals with starts demanding better terms to protect themselves.
It's like the company suddenly has terrible credit with everyone it interacts with.
Exactly. That's a great way to put it. And academics suggest the reason is that these stakeholders, unlike diversified shareholders, are exposed to the company's total risk, both systematic and specific. If the company fails, they lose out significantly. So they demand compensation for bearing that full risk.
So managing risk to avoid or reduce financial distress isn't just about dodging bankruptcy.
No, it's also about making it easier and cheaper to do business day to day, to maintain good relationships and favorable terms with customers, employees, suppliers. The more volatile the company's cash flows are naturally, the greater the potential benefit from risk management and avoiding these distress costs.
That makes a lot of sense. And thinking about distress naturally leads to funding, right? How does this affect getting money from outside, external funding, and agency costs?
Absolutely connected. When a company is in or near financial distress, trying to raise new money, either debt or equity, becomes incredibly expensive, if not impossible.
Why so expensive?
It leads to what's called the underinvestment problem. Even if the company has potentially profitable projects, it might have to reject them because the cost of funding is just too high.
Okay, break that down. Why would equity holders not want to fund good projects?
Think of equity holders as having a call option on the company's assets. If the company is already heavily indebted and close to distress, that option is out of the money. Any initial profits from a new project would likely go straight to the debt holders first to cover existing debts before the equity holders see a dime.
So the upside for shareholders is limited even if the project itself is good.
Exactly. There's less incentive for them to put more money in or approve projects if the first slice of profit goes elsewhere.
What about the debt holders' perspective?
Well, debt holders get a fixed return. They don't benefit much if profits soar. So especially when a company isn't in deep distress but maybe taking on more risk, debt holders worry. They worry that the equity holders will gamble with their money on risky projects.
Because if the gamble pays off, equity holders get the big upside. But if it fails, the debt holders are left holding the bag.
Precisely. So debt holders impose what we call agency costs. They might demand higher interest rates, stricter rules, covenants on what the company can do, making it harder for management to operate flexibly or take on new projects. They become reluctant lenders.
So distress makes funding hard from both sides. How does risk management help?
By reducing that volatility and the likelihood of financial distress, risk management can lower these agency costs. It reassures both equity and debt holders, making it easier for management to get the funding they need, maintain an optimal mix of debt and equity, and crucially pursue those profitable investment opportunities.
Keeping the wheels greased, essentially, which ties into the next imperfection, capital structure and something called information asymmetry.
Right. First, capital structure. If risk management leads to more stable, predictable cash inflows.
Lenders like predictability.
They do. It means the company can likely support more debt safely. And since debt is usually cheaper than equity, partly because interest payments are often tax deductible, the tax shield, being able to take on more debt appropriately, can actually lower the overall cost of capital and increase the company's value.
Okay, so stable cash flow enables more potentially value-enhancing debt. What about information asymmetry?
This is the classic problem, where managers inside the company know a lot more about its true health and prospects than outsiders, like potential investors.
Right, the insiders know more than the outsiders.
And because of that, raising external funds, selling new stock or bonds is often more expensive than using internally generated cash, retained earnings. Outsiders demand a premium because they know they have less information and worse about being taken advantage of.
So managers prefer internal funds.
Generally, yes. It's cheaper, less hassle, fewer questions asked. Now, if risk management makes cash flows more stable and predictable,
Managers can plan better.
exactly. They can forecast with more accuracy when internal funds will be available. This allows them to better match their investment plans with the availability of these cheaper internal funds, reducing the need to go out for expensive external capital raised under conditions of information asymmetry.
So it smooths planning and funding, reducing reliance on costly outside money. Okay, we've covered imperfections like size, taxes, distress, funding. Let's switch gears now to the people involved, the human element. How does manager behavior, their own incentives, play into this?
This is a really crucial area, and it brings us to some seminal work, particularly by René Skills. He looked at how managers' own financial stakes affect their approach to risk.
Okay, what did he find?
One key finding relates to managers who hold large concentrated stakes of the company's equity, maybe founders or executives with significant stock holdings as part of their pay.
What about them?
Still suggested these managers are actually more likely to want to reduce the corporation's overall risk.
Why? Wouldn't they want the stock price to go up, which might involve taking risks?
Well, yes, but unlike diversified investors, their personal wealth is heavily tied to this one company. They're exposed to both the systematic market risk and all the unsystematic company-specific risk. They can't easily diversify away the company's unique wobbles.
So their personal financial well-being is directly hit by company-specific downturns, unlike a diversified fund manager.
Precisely. So they have a strong personal incentive to reduce that unsystematic risk, the risk that diversified shareholders might not care much about.
But hang on, if the diversified shareholders don't value reducing that specific risk, and the manager uses company resources to do it anyway for their own benefit, is that actually adding value to the corporation? Seems like a conflict.
That's the core tension, and it's a great point. Stolz's argument gets a bit nuanced here. He suggests that, yes, While it seems the manager is acting partly out of self-interest, allowing them to reduce this unsystematic risk might have an indirect benefit.
How so?
By feeling more secure about the company's stability and their own wealth, these managers might then be better able to focus their time, their energy, their expertise on the strategic and operational things they can control, things that do drive long-term value, managing the business well.
So reducing their personal risk frees them up to be better managers overall.
That's the argument. It could enable them to focus on value creation, even though the risk reduction itself might not be directly valued by diversified investors. It's hard to measure this effect directly, though.
You mentioned they have concentrated stakes. Quick question. Why don't these managers just sell some of their stock and diversify their personal portfolio like everyone else?
Good question. The generally accepted reason is signaling. If a top manager starts selling off large amounts of their stock, the market tends to interpret that very negatively.
Like they know something bad is coming.
Exactly. It could trigger a sell-off and harm the company's valuation unnecessarily. So they're often kind of stuck with these concentrated holdings, which reinforces the incentive to reduce company risk.
Okay, that makes sense. Now contrast that with managers whose compensation is heavily weighted towards equity options. How do they behave regarding risk?
Very differently, typically. Equity options give the holder the right, but not the obligation, to buy stock at a fixed price in the future. Their value explodes if the stock price goes way up above that fixed price.
So they want high volatility, big swings upwards.
They benefit hugely from large increases in the share price. This means they have a much stronger incentive to undertake risky projects with a chance of a huge payoff, even if there's also a big chance of failure. They are generally less inclined to spend resources on managing downside risk.
Because managing risk might dampen those potential huge upside swings that make their options valuable.
That's the concern. In fact, equity options have often been criticized for potentially encouraging excessive risk-taking that might benefit the option-holding manager, but might not be in the best long-term interest of the company and its other stakeholders.
Is there evidence for this difference in behavior?
Yes, there is empirical support. Studies, like one by Tufano back in 1996, looked at industries like gold mining and found evidence consistent with these ideas that managers' compensation structure, stock versus options, significantly influences the company's risk management activities.
Fascinating how incentives shape behavior so directly. Okay, we've gone through the theory, the market imperfections, the human element, which brings us back to the really big question. Does all this risk management activity actually add value definitively?
Well, this is where the empirical evidence gets murky. Researchers have looked at this from many angles, examining companies that hedge versus those that don't, looking across different industries, trying to isolate the effects of different market imperfections.
What's the verdict?
The results are varied. Some studies find some evidence supporting value creation through specific channels, like tax savings or reduced distress costs in certain contexts, but others find weak or inconclusive results. There's no single slam-dunk empirical finding that says, yes, across the board, risk management adds X amount of value.
So after all that theory, all that real-world practice, we can't definitively prove it works, statistically speaking.
It's surprisingly difficult to establish that direct, quantifiable link consistently across studies. The overarching conclusion seems to be that corporations manage their risks in the belief that it will create or increase value. Managers act as if it does. The theoretical arguments we've discussed are compelling.
But the hard numbers, the empirical proof linking the action of risk management directly to a subsequent increase in market value, that remains elusive.
Largely, yes. The jury is still out in terms of definitive, universally accepted empirical proof. There are strong theoretical reasons, strong managerial belief, but the direct statistical smoking gun linking the activity to value increase hasn't quite been found consistently.
Wow, that's quite a conclusion. So there's this fascinating tension.
Absolutely. A tension between strong theory, strong belief in practice, and somewhat ambiguous empirical validation.
So we've explored this landscape today. Powerful reasons why risk management should add value based on market imperfections and manager incentives. A strong belief driving corporate behavior, and yet the empirical evidence struggles to draw that clear, direct line to increased value.
It really makes you think, doesn't it? If after decades of research and practice, that direct link remains so hard to pin down empirically, what does that really imply?
Yeah, how should companies think about prioritizing these often very expensive risk management efforts? How might the gap between theory, belief, and proof shape corporate strategy moving forward?
And for you, our listener, what's the key takeaway when you think about the true impact of managing uncertainty in the corporate world? Something to ponder.
Definitely food for thought. We'll leave it there for this deep dive.